In 4.8 we've got on the 1st of March some opening balances which we haven't dealt with before. So the first one we've got three assets. We've got cash at bank, debtors and stock. Then we've got creditors and GST as liabilities, and that leaves capital as our owner's equity account. So following our rules of debits and credits, we're going to enter those, and cash at bank is a debit balance. So we write the first day of the month, the 1st of March, the word balance, and $2,300. We'll do the same for debtors and for stock, and that completes all our debit balances for the assets. We've then got the creditors. So creditors are a liability, and liabilities have credit balances. So on the credit side, we'll write the 1st of March balance and 200, and same with GST, 1st of March balance 5,000. That leaves capital, which is an owner's equity account. Owner's equity goes up on the credit side, so we've got an opening balance of 22,200. Then we have the following documents. So unlike the previous questions where we've got dot points, we've now got to interpret some documents. So the first thing to go through is that figuring out what sort of document it is. So that's a receipt. It says tax invoice, but that doesn't necessarily mean a credit transaction. It just means there's evidence of GST. So because it's a receipt, there's obviously a cash exchange here. And figuring out who from, our business is Vicky's Vax and our name's at the top. So this has been issued by us, so therefore we're the ones that have received the money. It happened on the 2nd of March, and it was a cash sale for a vacuum, and it was $440 including GST of $40. So we're going to deal with the sale amount. So cash at bank is an asset going up, which is a debit. We've collected GST, that'll increase our liability, and we've made a sale, which is a revenue. Revenues increase on the credit side. However, we've got to factor in the cost of sale, and the additional info we're given is that it's management policy to double the cost price of all stock. So in this case, the sale was $300, or if it was, the cost price would be $150. So in this case, the sale was $400, so the cost price will be $200, and the stock will decrease by $200. Next transaction is another receipt. So we've got the receipt, we've got our name at the top. It's the 7th of the 3rd. It's another cash sale, $220 including GST. So we've got $220 going into the bank. GST goes up because our liability has increased, and sales, which are revenue, is going up as well. Taking care of the cost of sale expense, that's a debit, and that decreases our stock on the credit side. We now have what looks like a different document. We've got Vicky's Vax, our name is underneath, so this has been issued to us. The date's the 4th of March. It looks like we've bought 10 vacuum cleaners for a total of $1,500 plus GST. It says tax invoice, but I still don't know whether this is a credit or cash transaction. What gives it away that it is actually on credit is it says terms 30 days. So the first thing that's happened is we have more stock. Stock is an asset. We have $1,500 more. We've also been charged GST. So GST, when we get charged, it decreases our liability. So liabilities decrease on the debit side. And on the credit side, we're going to have creditors go up because we haven't paid any cash. Creditors go up on the credit side, and then our debits equal our credits. Then have another cash receipt, this time for $330 plus GST. It's another cash sale. So we'll go debit to our bank account $330, credit to GST of $30, and a credit to our revenue of $300. That'll leave a cost of sale of $150, and our stock will decrease $150. Then have a different type of document. So we've got the date. It says it's for advertising. There's $165 made up of $150 of advertising and GST. And there's a check number. So this is a check butt. So this is evidence of us having made a payment. So in this case, we'll start with the advertising expense. The advertising expense has gone up $150, so that'll be a debit. We've been charged GST, which will reduce our liability, so that'll be a debit. And overall, we've paid $165, which will decrease our cash. Have another payment. This one says for wages, $200 and a check number. So in this case, we've got an expense going up, which is a debit called wages. And on the credit side, we've got cash at bank going down. for $200. Another cash receipt. This time it says we've made a cash sale for, it's a little unclear there, but it says $330 including GST of $30. So in this case GST is a liability because we're the ones collecting it, and we have a revenue of $300 which goes up on the credit side. Then we have a cost of sale expense, which is a debit, going up $150, and stock, which is an asset, decreasing $150. Another cash receipt, and this time it's for another cash sale of $440 including GST. Debit to cash, credit to GST, credit to sales, and we'll deal with our cost of sale expense and less stock, which will be a credit to an asset. Now have another invoice. This time our name's at the top, so it's evidence of our business is the one that's made the sale. It says tax invoice, but again that doesn't necessarily mean a credit transaction. What gives it away is the terms of 30 days. So there's what we've sold including the GST. So it's an $1,800 sale plus GST of $180 for a total of $1,980. So the first change will be, instead of cash going up on the debit side, it'll be debtors. Debtors are an asset, so that'll go up on the debit side. Even though they haven't paid, they still owe us money, and that's an asset that increases. The credits will remain the same in that we're charging GST, so that'll increase our liability. And then we've got revenues going up $1,800 on the credit side. Now we've got a debit, we've got to take care of the cost of sale of $900, and a credit, which is the decrease in stock of $900. Another check butt, this time it says it's for stationery, $60 plus GST. So we've got $60 of an expense called stationery. We've paid GST of $6, and our cash at bank asset has decreased $66. Another check butt, which is for wages, $150. So wages are an expense, which are debits, and then we have credit to cash at bank, which is $150.